This is another section.
Good morning, everyone. Please, Esther, can you hear anything? I want to be sure it's not from my end. I don't know if you can hear anyone speaking.
Sorry. Good morning, class. Can we all hear me now? I think it's my PC that tripped off. Please confirm you can hear me.
Can you hear you now?
All right. So good morning all.
Good morning, sir.
Welcome to another section. So today we'll be looking at double entering system. Double entering system. So understanding double entering means that we need to go back to understanding our accounting equation, where we said asset is equal to liability plus equity. Now, the basis of every account lies with your application of double entry. So it is very, very important you understand the concept of double entry, because this is where the bedrock of accounting lies, double entry. So let's begin. So remember, we discussed some accounting concept and convention last week, where we looked at what we call the entity concept. And we say the entity concept is a principle that states that a business is different from the owner. And as such, business is treated as a separate legal entity. And we also discussed that the going concern concept, where we looked at it that business would assume not to cease operation. That is, business see itself that it's going to it is going to continue operation in the next foreseeable future. Now, this accounting equation is expressed mathematically as asset equal to capital plus liability. Now, in our earlier chapter, we discussed what an asset is. We said that an asset are resources owned by an entity arising from past events in which economic benefits will flow into the entity, or it will result in an inflow of economic benefit. We now said capital, which is equity, capital and liability represent claims to those resources. First, we described liability as an obligation also arising from past events that will result into an economic outflow to the entity. And we said equity is the residual interest after all liabilities has been taken care of. That's, we say equity can also be seen as net asset, where your total asset less your current liability will give you your net asset or your shareholders fund. So capital in a layman understanding is the money injected by the owner. Hence, capital could be the owner's contribution, or the owner go to the bank and pick a loan to finance that business. Now, if it is the owner's contribution, it becomes equity. Now, if he goes to borrow, it becomes bank loan, which is a debt. That is why you can see that capital and liability represent claims to those resources. Now, in our prior class, we also discussed the classification of assets. We said assets can be classified as to non-current and current. The non-current is what we call the fixed assets prior to now, but as a result of IFRS change, it's now non-current. And we said these ones can be held in operation for more than 1 year. So any asset that span over a longer period, let's say more than 1 year, is a non-current asset. So you can see the examples. We said property, plant and equipment, machineries, patent right. However, patent right is an intangible asset because you can't see it, you can't touch it, but you can feel it. Then we also have the next category, which is the current assets. Most times, these current assets are normally turned into cash, or these are assets that can be held in operation for a period of time, normally 1 year. So it doesn't span more than 1 year. And examples of these are inventories. That's inventories held for whether goods manufactured or purchased for resale. Then we have receivables, trade receivables, which prior to now we call them debtors. Debtors. Now it's now trade receivables. So these are amounts owed by customer for credit cash sales. The next classification is the liability. The liability. So liability is also classified into current and non-current. So the non-current are obligations that are falling due after 1 year, which is 12 months. So we have it to be long-term loan, bonds. While the current liabilities are those obligations falling due within the reporting period, let's say 12 months. And examples are your creditors, which is now called trade payable, taxes, that's tax liability, and bank overdraft. Lastly is the capital, which I said equity, which is the residual interest in an entity after deducting its liabilities. So it could also include owner's capital and retained profits. Now, the accounting equation in practice. We should be able at all time from a transaction be Hello, good morning. Can you all hear me now? Hello, good morning.
Yes, we
Can
can
we
hear
all
you
hear me
now.
now? Okay, sorry
Good
about that.
morning, we can hear you now.
My system went off, but I don't think it will go off again. Okay, so before the network interrupted, we were talking about the accounting equation in practice. And I said, as time goes on, we should be able to identify what makes up an asset, what makes up capital, and what makes up liability. And just in a nutshell, double entering is a principle that states that for every debit transaction, there must be a corresponding credit entry. For every debit transaction, there must be a corresponding credit entry. Let us look at this transaction as we run through the cost model. Then we solve some of the practice questions together. So we can see that Adeyemi set up a business to sell shirts
Sorry,
from a
sir.
stall.
Excuse me, sir.
Can you hear me?
Excuse me, sir. Yes, sir. Is this
Yeah, morning.
today's class?
You said
Have we started today's class, or it's from the previous class?
it's from the previous class.
Okay, thank you.
It's just a continuation from the previous class. So we said Adeyemi set up a business to sell shirts from a stall in the marketplace. He begins by depositing 600 naira. He begins by depositing 600 naira into the business bank account. So what comes to our mind as an individual? Let's say you don't have an idea. What comes to your mind for this transaction? Please, I want everybody to speak up because this double entry is the key aspect of our accounting. And once you don't have a grasp understanding about it, then it means that you are an accountant of doom. But I'm not saying you guys are accountant of doom, but I just want us to follow accordingly. So anybody, please. Uh, Anybody, what comes to your mind when you see this kind of transaction? He sells share. All right, everybody is quiet. So let's just go to the major thing at hand. So let me open my book I was using. So we can all see my screen, right? So from here, we're told that Adeyemi set up a business. Now, he set up a business to sell shirts from his stall in a market. He begins by depositing 600 naira. Now, from your knowledge of accounting equation, you start by depositing. So it means that he deposited cash into the bank, right? So we said assets equals to capital plus liability. If you remember, and we said assets are resources owned and controlled, right? And we said these two are claims on those resources, right? So we're not saying that Adeyemi, the main person now is Adeyemi, he deposited 600,000 into the bank. So to Adeyemi has deposited cash of how much? 600,000 naira. Now, since Adeyemi has deposited cash, it means that that cash could form as Adeyemi's capital he's bringing into the business. So he has a capital of what? 600,000 naira. Why his liability is what? 0. Is that taken? And if that is taken, we'll move to the next illustration. We said Adeyemi borrowed from his brother for business use. Adeyemi borrowed from his brother for business. When you hear borrow is an obligation. It means that he has to pay back. So coming here now, since Adeyemi had borrowed, what has happened? He borrowed 600. So his brother is going to give Adeyemi cash, right? So Adeyemi cash balance would increase by what? 800,000. Yeah. And since he borrowed it as what? It's not as capital, it's a liability which is going to pay back. Then here would be 0, but the liability will now be what? 800,000 naira. Is that taken? So his balance of cash would be this plus this. His balance of capital will be this plus this. And his balance of liability would be this plus this. Is that taken? So we move on. Now we are now told that Adeyemi purchased a van using the money he borrowed from his brother. Adeyemi purchased a van using the money he borrowed from his brother. Now, coming back to our accounting equation. Now, if he's borrowing, it means that he has to go to the bank. And remember, it's either bank or cash. Remember, bank or cash is an asset. And the category of this asset is a current asset, if remember from when we started this explanation. Now, it means that if he used it to purchase cash, what has happened? It means that that same money, yeah, that he borrowed, he took it to buy an asset, which is the motor vehicle. So that motor van, which is the motor van, he borrowed 800. So it's still there, 800,000 naira. It's still there. His cash is still here. Yeah. But the cash value will reduce. The cash value will reduce, which will now be this 800,000. This 800,000 negative because he took it from the bank. Yeah. But his capital will also still be the same because nothing has happened to his capital. Then what else? His loan has not paid back will still be the same, which is this. Don't forget, the accounting equation says assets equals to capital plus liability. So if I decide to add this plus this, it will still be equal to the assets, which is equal to sum of everything here. Sorry. Equals to sum of everything here. Is plus 800 plus minus 800. This is not equating right. So cash has left, but motor vehicle came in. So they should still be 800. So this has gone. So when we add this together, it ought to be 1,4, not even 1,6. So here we have, if you add these two together, it's also going to be 1,4, not 1,6. So this accounting equation helps us to identify transactions according to what category they fall, bearing in mind our double entering principle, which says for every debit, there must be a corresponding credit entry. That's for the account to balance. Let's move on to a more complex scenario. Now we'll see an additional transaction for 6 months ended June 2025. They now told us that below are the business transactions undertaken by Ademi and their effects on the accounting equation. So we'll tell them what will be the effects on the accounting equation. So let's start one by one. Transaction 4. We're told that Ademi buys a market stall and pays 100,000 naira in cash. He buys a market stall and pays 100,000 naira in cash. So if he's paying this in cash, what treatment? Who will be affected and who would not be affected? So what does the principle of double entry says? He buys market stall, which is an asset, and pays in cash. So it means that if I'm to establish the double entry concept, it means that he has the market stall and he has his bank or cash accounts. So both will have debit and credit. Both will have debit and credit. Now, if you go back to the question, what did they say? He buy a market stall and pays cash. If he buys, it means that cash is leaving, market stall is receiving. Yeah? So it means that I'm coming here, credit means out, debit means in. So we have our market stall of 100,000. And we have, he bought it by cash of 100,000. Yeah. So what will be the effect of this transaction? The effect of this transaction, let's just write the effect. The effect of this transaction will be that something happened to increase something. Yeah. So it means that an asset decreased, another asset increased. Yeah. An asset increased, another asset decreased. And what asset has decreased? Cash decreased for another asset to increase, which is the stall, increased. Are we getting it now? So there's no change in assets, it's just reallocation. No change in assets, it's just reallocation. Let's look at the next transaction 5. Transaction 5. They said, are there any purchase shirts inventory worth 360 on credits? He purchased shirt worth 360 on credits. Now, remember, when we're talking about the categories of assets and liability, we said when you buy something on credits, there's a party involved, which is a liability. It means that you have to pay somebody. So you went to buy from the supplier. So it will give rise to what we call a creditor, which is now called payable. So we have two parties to be involved here. We have inventory and we have a straight payable. We have debit, we have credit, we have debit, we have credit. So if we go back to the same transaction, what happened? He purchased shirts worth 360. He purchased shirts worth 360. It means that something will be coming, which is 360 purchases and inventory. $360. So what is the effect of this transaction? What is the effect of this transaction? So if we look at this transaction critically, you see that assets has increased and liability has also increased because assets by its nature has debit balance, while liability by its nature has credit balance. So the effect is assets, which is the inventory, increased. Uh, and what's your liability also what's increased because you have an obligation to pay. So both assets and liability increased by the same amount. So let's move on very fast. When I told that transaction 6, Ademi pays 200 to his suppliers. He pays 200 to his suppliers. What has happened? It means that there's a cash and there is also a trade payable. You also have debits, you have credits, you have debits, you have credits. What has happened here? He pays his creditor. So it means that what will happen? Cash is going out. So we have our payable of 200,000, and we have our cash of 200,000. So what is the effect of this transaction? It means that assets has what? Decreased, and liability has also decreased with the same amount. Are we following, please? Are we following? Okay. So let's move on to the next transaction. We're told that Adeyemi sells 50% of shirts, and this shirt costs 840 for 240 in cash. He sold 50% of shirts, which cost 180 for 240 in cash. What has happened here? What has happened here? So in this case, we have what? Cash, which is the assets. We have the other side, which is the sold shirt, which is an inventory. So we have our debits, we have our debits, we have our credit. So from the question, they said he sells 50% of this shirt, 50%, and this shirt cost 180 for 240,000. So it means that he's going to receive cash of 240, which is 240 being sales. Then what will happen to the inventory? What will happen to the inventory? So the inventory would reduce by 80, 180,000, 180, which is sales. So if you reduce inventory that used to cost 180, sold it for 240, it means that there is a profit of how much? There's a profit of your 240 minus your 180. You have if you have a profit of 60. And now if it's having a profit of 60, what happens? This will increase his capital, which is this 60 will be taken to what we call retained earnings, which will form part of his capital or equity, as the case may be. And his assets or his profits would also what increased by the same 60,000. Are we following? Hello? Are we following? Okay. So they said Adeyemi repays loan of 200,000 naira. He repays loan of 200. Sorry, Adeyemi sells more shirts that cost 100 for 180 on credit. More shirts that cost 180 on credit. He sells more shirts that cost. So two things would happen. We have his inventory, and being that is on credit, it will give rise to what we call debtor because he's selling to customer. We have your trade payable, sorry, trade receivable. We have debits, credits, debits, credits. So being that he sold more of this item on credit, so it means that our receivable will increase by 180,000 and our inventory will reduce by 100,000, being that that was their original cost, right? Then what will happen to our equity? It will also what increase, and it will increase by 80,000. So we have a profit of 180 minus 100, which is 80. So this 80,000 will also go to increase our equity. 80,000 will also go to increase our equity. Adeyemi pays loan. Adeyemi pays loan of 200,000. So two things will happen: cash and loan liability or loan. So he pays loan, which is that is bank or cash. and loan. So we have debits, we have credits, we have debits, we have credits. So if he pays back his loan, what does it mean? Something is reducing the cash, which is loan, of how much? 200,000. And loan will also reduce by 200,000. So the effect is that cash reduce, that's asset, and liability reduce, that is loan. Then Adeyemi pays 120,000 to his trade suppliers. He pays 120,000 to his trade suppliers. So it is cash and trade payable or trade supplier, as the case may be. Cash and trade payable. You have debits, you have credits, you have debits, we have credits. So it means that cash, since it's paying, cash will reduce by how much? 120,000. And trade payable will also reduce by 120,000. So the effect is cash, as cash decreases, trade payable also decreases. So both asset and liability decrease equally. The next is Adeyemi receive 160 from customer. He receives 160 from customer. Now, if he's receiving 160 from customer, which is the trade receivable, what will be? It will be cash or bank and trade receivable. So we have debit, credit, debit, credit. What has happened? So is receiving cash from customer. So cash would increase by 160 and receivables will decrease by 160. So the effect is cash increase as receivable decrease. So both assets, one asset is increasing, the other asset is decreasing. He now said, Adeyemi received Adeyemi purchased additional shirt worth 50,000 on credit. He purchased additional shirt worth 50,000 on credit. So what will happen? You have inventory or shirts. I have what? Trade payable. You have debits. You have credits. You have debits. You have credits. So if he's buying additional shirts, it means that inventory would increase by that additional shirt of 50. 50. While trade payable will also increase by 50 because he has to pay back. So his asset has increased as his obligation increased by the same amount. So lastly, Adeyemi withdraws 80,000 in cash, 80,000 in cash, and inventory worth 40,000 for personal use. So when you are hearing someone withdrawing for personal use, something will come to your mind. That's drawings. Drawings. So what will be the effect of this transaction? Two things: cash and inventory. You have debits and credits. I have what? Drawings. Because for personal use. So what has happened here? They said he withdraws 80 in cash and 4,000 watts inventory. So our cash and inventory will reduce by what? The 80,000 and 40,000. Then under our drawings, debits and credits, what will happen? Under our drawings, since it's withdrawing for personal use, so this drawing affects equity and capital. So what the drawing does is it will go and reduce capital by, if I add 80 plus 40 as 120,000. So the effect of this now is that cash and inventory has reduced. Then capital, which is equity, will reduce by 120,000. Is that taken? Class, is that taken? So, I mentioned something about drawings. So what is these drawings? They say the owner or business owner can withdraw profits made by the business for personal use. In principle, they may draw out of profits, but in practice, most owners choose to draw only a portion and leave the remainder to support the business growth. Profit retained in business. So if we retain profit in business, we call it retained earnings. Profit withdrawn by the owner is known as drawing in the case of sole trader and partnership. Then for companies, profit distributed is what we call dividend. Is what we call them. So all these concepts, we need to understand them. So they can ask us, dash is profit distributed to shareholder. A, so and so, B, so and so. So the answer is drawings. So while drawings are commonly used, made in cash, they can also take form of inventories, non-current assets such as motor vehicles, whenever the owner takes goods or other assets for personal use. It is treated as drawings. And remember, it reduces the owner's equity. So these are what we discussed so far, and we explained it in the worksheet, which I would share with us later. However, we can also tabulate them into the accounting equation, just as we have done. Just as we have done. Please, are we following? I want to know if we are following, before I move on to tabulate it into an accounting equation. Vivian, Lois, are we following? Huh?
Yes, sir.
Okay. For any question at this point?
No, sir.
Okay. So let's now tabulate it based on our understanding of the accounting equation. All right. So let's um, so let's tabulate what we have just done so far into the accounting equation for a clearer picture and understanding. Though we have done a part of it here, but let's just do it so that for a better understanding. So we started from transaction 4. So we started from transaction 4 to here. So let's present it based on accounting equation one by one. So we have our assets, we have our equity or capital, we have our liabilities. Liabilities. So we said asset equal to capital plus liability. So based on from 4 downward, transaction 4 downward. So if we look at it, it's a market stall. We have cash and bank. And if we remember, we said he bought market stall and he paid cash for it. So if he's buying market stall and is paying cash for it, what has happened? It means that his cash will reduce, the market stall will increase as an asset, right? So we have it here. Assets based on the cash is a minus 100,000 naira. The stall he bought will form 100,000 naira, right? So that's that for that transaction. So why we have our capital to be 0, our liability to be 0. Then the next one is let me go back to the question so I can have a clearer picture. The next one is that then me purchase shirts. What credit? 360 on credit. So if he purchased shirts, so two things would have happened. It would have increased his assets and also be a liability. So here we have inventory. $360. Right? Then we also have payable, which is a liability. 360,000 naira. The next one is he pays 200 to his suppliers. He pays 200 to his suppliers. So if he's paying, it means that he's taking money from the bank. So it means that cash share will reduce. Minus 200. And his liability will also reduce. It's also payables. Minus 200. The next one is he sells 50% of his shirt, which cost 180 for 240 in cash. So what has happened? It means that he has received cash of 240 and his inventory has also reduced because he sold it by minus 180,000, but he made a profit which will form part of his capital. Profit of 80,000. So that's the 80,000. Is it 80? 240 minus 180. That should be 60,000. The next is he sells more shirts. He sells more shirts, cost 100,000 for 80,000 on credit. So if he's selling more shirts, so it means that he sold it on credit. So it's going to give rise to trade receivable of how much did he sell it? 180. 180. Then his inventory will reduce by minus 100,000. But his profit will increase by 80,000 naira. Then Adeyemi repays loan for 200,000. He pays good morning. He repays loan for 200,000. So under the asset money, so under the assets, his cash, because he's taking money from the bank, will reduce minus 200,000. Then his loan would increase. So his loan will reduce by 200,000. 200,000. Then Adeyemi pays 120 to trade suppliers. He pays 120 to trade suppliers. So it means that his cash balance, cash
I don't know. Don't go my mommy place.
We reduce by 120,000.
So if not, I need to disturb to make early.
Then payable will also reduce by minus 120,000. Then Adeyemi receives 160 from customer. He receives 160 from customer. So it means cash would increase by 160. And receivable we reduce.
Oh. Life when I get people, person will not one big chicken.
Then Adeyemi pays additional purchase additional share worth 50,000 on credit. If he purchase additional share worth 50 on credit, it means that his inventory will increase. Inventory will increase by 50. $50,000. And since it's on credit, payable will also increase by 50,000.
That cup, I hope dust not the inside this.
Then lastly, Adeyemi withdraws 80,000 in cash and inventory worth 40,000 for personal use.
This is my part.
So cash and inventory will reduce. Cash. The cash was minus 80,000. His inventory minus 40,000. Yeah. Then his drawings to reduce profit, to reduce capital. Drawings, like we said before, which is minus 120,000. So that is how it will be presented based on the accounting equation. Any question at this point? So I believe there's no question, and if this question comes out, we'll do justice to it all. So here they said we should note that original capital only increased through retained earning. Original capital can only increase through retained earnings. Profit minus drawings and additional capital introduced by the business. Moreover, the accounting equation can be used to derive missing figures. So assets is equal to capital plus additional capital plus profits minus drawings. What are they saying here? We're told that capital can only increase through retained earnings, and we said retained earnings is the portion of profit not distributed, or portion of profit retained or plowed back into the business. So if we have that understanding, then it means that we can practice this question to see what they are saying. They say Oleide operates a business as a sole trader. Net asset of the business total 670. When you are saying net asset, it means total asset minus current liability is 670. So during the year, the business made a profit, and Oleide made a drawing of 220. Due to shortage of cash, he introduced 40,000 in early June. And now told us that we should how will the net assets as at 30th June 2025 be calculated. So having understood that asset is equal to capital plus additional capital plus profit less joints, then this will be expressed like this. So this kind of questions can be given in your MCQ. So solution.
And I feel that for
Solution. We have equity on net assets as the question says, which is 70.
person we know him mommy they suffer. Another person.
I don't know.
70. Then there is a profit of 250.
Anybody we carry, I don't know.
Profit
I found that you could go back and come back.
of 250.
I said that you know that's let everybody. I mean, get children anybody.
Then he introduced capital due to shortage of cash. Capital. Introduced, which is 4,000. And he made drawings, which is 220. 220,000. So our closing equity or closing net assets would be this plus this minus 220. So our closing net assets would be 740. 740.
Anybody come for them, I'm going to have the eye of the dog something.
And the limit
So, basically,
How they do the work?
the double entering principle, having understood double entering principle, it's best we apply it on transactions.
Yeah.
So, how do we apply these transactions? We apply it from the source document we received down to cash book, or what we call the general ledger. Then we extract a trial balance from the general ledger and prepare our statement of profit or loss from the trial balance and also statement of financial position.
They say they don't agree.
What of this way of us work?
Three of you if you work. Or me,
So
you and her to work.
from
They say me and her.
those analyses we did, we can extract our statements of financial position. However, I won't do that in this class. I'll use a more detailed question that's from your Pathfinder to demonstrate before we wrap up class. So you can see when they extracted their statement of financial position from all you see that your assets, your total assets will be equal to your total liability at the end.
They say only two of them.
So if I decide to add up all these my transactions from the beginning to this, because these are all my assets, these are all my equity, and these are my liability, it should be equal to your assets at every given point in time, except something is wrong. But if nothing is wrong, all things being equal, then your account will balance.
Yes, can be like that.
There's another principle called dual concept. It means that every account should have a debit side and a credit side. What do they mean by debit? What comes in? What do they mean by credit? What goes out? I know most of us will confuse our bank transactions. That when you receive a credit alert, it comes in. When you receive a debit alert, it goes out. But however, it is the same concept, but only that in a wrong understanding. What that means is in the bank, in the book of the bank, what has happened is that they have credited your book, which you see as credit alert. But in your own personal book, it came in, it has been debited, so it came into your own book. So when you also go deposit in the book of the account, it has been debited, but in your own book, you see it as credit. So it's just the bank maintains individual respective book for all individuals. Just as we just did cash inventory. That's how it is everywhere. The bank also maintains the customer individual books. So as one part is affecting, the other part is affecting. That's where the concept of double entry comes in. So the accounting equation illustrates the dual nature of business, every transaction, every effect. So at least two places to maintain a balance. So if I'm taking cash from the bank, two things, it's me and my bank. And me and my bank maintains debit and credit. So the principle of double entry, which is transaction recorded into account once as a debit and once as a credit. While the accounting equation is helpful, it is best we understand the impact of this transaction. It is not practical for recording large volume of transaction activity, or a typical business may conduct thousands of transactions in a single period, making it inefficient to update the equation manually. So a business engage in thousands of transactions over time. So we have what we call transaction, books of prime entry, the accounts in the general ledger. Then we extract the trial balance, and from there we prepare the financial statement. So this will be covered in the later chapters. So how do we account for our credit transactions? How do we account for cash transactions? How do we account for revenue transactions, assets, liability, and vis-a-vis? We'll see this. And what are books of prime entry? This is the first place where the transaction is recorded before they are being posted into the general ledger. So the general ledger warehouses all transactions. The trial balance extracts from the general ledger. And the trial balance is used to test the arithmetic accuracy of the general ledger. If your double entry were properly done, the trial balance will balance. But if they were not properly done, it will fling out the balance. The trial balance will not agree.
Just like this with Boston and water. You know, introduce people.
So basic rule of double entry. Debit and credit entry in a T account, which just demonstrated. Financial transactions are recorded in the account in accordance with a set of rule or convention. This following rule applies to main ledger and general ledger. So what they mean by nominal ledger, these are ledgers that warehouses names of individuals. Sorry, names of non-individual, like your asset accounts, your expenditure accounts, and the rest. Then we also have personal ledger. This one has to do with names of individual, Ojo and Sons, and so on and so forth. So every transaction is recorded twice, as debit entry in one account and as credit in another. Total debit entry and total credit entry must be equal to maintain the accounting equation. Debits are made on the left hand side and credits are made on the right hand side. But remember, debits are the giver, credits, sorry, debits are the receiver, credits are the giver. Please don't forget that all debits are receiver, all credits are the giver. As illustrated here, this is an account. Credit transactions, debit transactions, and ensuring that it's match all entries. So alternative presentation, it could be a vertical, but best practice over time is always T. It's called the T account. The rules of debit and credit. In the main ledger, there are accounts for assets, liability, equity, income, and expenses. So all first account has what we call a debit balance. All liability and equity has what we call a credit balance. All expenses has debit balance, and all income has credit balance. Anything you see on the debit side, it means that there's an increase in assets and a reduction in liability, also a reduction in income. Anything you see on the credit side, it means a reduction in assets, an increase in liability, an increase in income, or an increase in capital. So this is the basic rule that you'll be familiar with over time. So being an accountant, you need to be solid in double entering principles. That is the basis for accounting preparation. Don't forget. So we can see here, purchase invoice is received for electricity charge for 46,000 naira. Now, when you are purchasing electricity is an expense. So it being an expense, it means that it's going to increase the expense, and also if it is made on credits, it will also increase the liability. Because here they did not tell us that it was paid. Just give me a minute, please. I'm back. So, being that this transaction was not, we're not told whether it is cash or it's credit. So it means two things would happen. Expenses will increase and increase in liability because we're not told whether this transaction is made by cash or by credit. But if it has been told that it was made by cash, then it means that the assets will reduce because cash is going out and paying for the expenses that will be increasing. So this can be expressed as debits, electricity, and credit expense payable. This is what we call a journal. So this journal will be dealt with in subsequent chapter, but in just for summary, journal in practice is used for adjusting entries to correct error or to account for transactions made on credits, just in quotes. So double entry. Can we all hear me? I can see that there are only 3 people. Are we following? Am I too fast? Please signify, please, before we move. Viv and Lois,
Before it's
I can hear you, sir.
are you getting it? Because that's the
Yes.
major important thing. Okay,
Yes, I'm getting it.
okay, let's move. So double entry keeping and cash accounts. So an entity usually keeps separate accounts to record cash. One for which is cash at hand and the other for which is cash at bank. This might help us learn the rule of double entering by remembering that transactions, including receipt or payments of cash into either cash at bank or cash at hand, are recorded as follows. So for cash at bank account is an asset account. That's the monies that goes into the bank, which is an asset. For receipt of cash, these are recorded as a direct entry into the cash at bank account because receipts add to cash. Payment of cash reduces cash and they are recorded as credits entry in the cash at bank account. So what are we saying here? This is expressed like this: cash at bank. When you have a cash at bank account, what are the likely things that would happen? That is transaction that provide increase in cash. It means that there's a sales or you receive money from your trade receivables or the owner introduce capital in form of cash. What could likely reduce it are whether there's an expenses being paid for a payment or whether there is a payment to suppliers, which is the trade payable, or whether there's a payment for a new asset or where there are drawings made out of profits by the owner. So would demonstrate this shortly. I think I can even allow you to demonstrate this because I've been saying it, but let's not be too fast. So we'll all demonstrate it together for better understanding. Then I would test you with the practice question as an assignment, which will be submitted to me. Let's quickly demonstrate this. So we're told that Adeyemi revisited. The following transaction relates to Adeyemi's business. And we're told that we should post all transactions to the ledger account. Post all transactions to the ledger account. So let's start with transaction 1. T1. Don't forget, the name of the person is Adeyemi. So we're told that Adeyemi introduced 600 cash as capital. Adeyemi introduced 600 cash as capital. So what comes to our mind on having understood the accounting equation and how it applies to double entry? If he's introducing cash as capital, so it means two parties will play. It's either cash or bank and capital. So we have cash / bank account and capital account. So you have your debits, you have your credits, you have your debits, you have your credits. So if he introduces cash as capital, it means that somebody is giving while the other person will receive. So who is giving? So it's one thing to be able to identify the giver and the receiver. So if Adeyemi introduces cash of 600,000 naira as capital, it means that something is leaving his bank to capital. So, and I told us that debit is receiver, credit is giver. So here you have capital, 600,000 naira. Let me put it as a item. Yeah.
Excuse me, sir. Excuse me,
Yes, I'm
sir.
with you. Yes, I'm with you.
Yes, sir. Please, I want to log out of the class. I have low battery, sir.
Okay, it's fine. Then for the other person, capital will receive what? Cash. That is from bank, cash or bank account for 600,000 naira. Very simple. Understanding who is debiting, who is crediting. The next is transaction 2. Adeyemi borrows 800 to purchase a van. He borrows 800 to purchase a van. So when he's borrowing, what comes to our mind is loan, right?
No.